Hi everyone, Namaste. I'm Paramita Chatterjee from Deal Street Asia, and I welcome all of you here to our flagship Asia PVC Summit 2022. Well, I have with me Mr. Satish Chandar, partner at True North, which is one of the oldest homegrown private equity firms in India. Now, just to take you a brief background about True North, it manages about 3 billion in capital under 6 funds, and it primarily invests in 4 sectors. These are healthcare, financial services, consumer, and technology. And mind you, these are the sectors that are witnessing the most amount of traction in India right now. So now just to step back and take you through a brief background once again about Satish. He joined True North in 2005 when private equity as a sector was still at its nascent stage in India. Now, from then to now, the sector has seen a slew of changes, be it in terms of investments, the new LPs coming in, the startup ecosystem bustling with activity. I think the whole ecosystem has changed. So, given that he's been in the system for so long and has seen several successful cycles of investments and exits, we will request Satish to throw some light on how he plans to put his experience to navigate the current macro environment. So, on that note, I welcome you, Satish, here. Thanks so much for sparing time to join us today.
No, thanks, Paramita. Thanks for a very kind introduction, and I welcome everyone to this session. Sorry I couldn't be there in person, but happy to talk through some of these points.
Thank you. Pleasure is all ours. So I'll begin with, the big picture question that's weighing on everyone's mind. Everyone's talking about the uncertainty in the global market currently with, be it geopolitical issues or equity market correction, higher interest rates, higher inflation, all of them, occurring in unison. Now, given that India can't be isolated from it, what do you think about the slowdown that's weighing on the Indian economy? How real is that, and how deep would that be according to you?
No, sure. So you're right. Nobody is an island by themselves. All of us are in a connected global economy. You're right. As we look back, could things have been better without the war, without all these disturbances? Definitely yes. But I guess as we've been following it for the last couple of months, I think a couple of points. Yes, it could have been better. But I think broadly the way we are seeing this is we are just stepping back, seeing it in context, and seeing India versus overall global economy. India did go through a slowdown, but I think there was an extremely sharp recovery post-COVID. We did go through that slowdown pre-COVID, then there was this COVID, but this post-COVID, I think we have been recovering quite smartly. Now, is that recovery going to be slightly muted in terms of all the global geopolitics and other issues that are happening? Yes, but a lot of it is played out over the last 5, 6 months. And if I broadly have a look at where we currently stand, I think we are still doing good in terms of our GDP growth is still good compared to last year. And even with the base effect removed, we still grew like a 13.5%. But if you remove the base effect, I think for a full year, we should be anywhere still between a 7 and a 7.5%. Now, compared to all other economies in terms of how they are growing, I think we find that extremely encouraging. Second, there is, of course, with inflation globally, there is imported inflation. And more importantly, how central banks are tackling inflation. There is going to be some effect in terms of capital flows and all that. Does that have an effect on India? Of course, yes. There is a pressure on the currency. Still, when I look back again, wearing the relative hat, are we doing slightly better than other economies in terms of how our currency has performed? I think we have several factors. We can talk about that as we move forward. I think to a large extent, even our global forex reserves helps us in terms of how our currency has stood. So that is another factor that I see. And even I'm not taking even headline numbers, even when you see the split, right? Services, which different sectors, how are they performing? I think barring a couple of sectors like oil, like auto, and effect of inflation through oil, which is also moderating, I think we see encouraging signs across several consumption and investment related themes in India. So to that extent, there is a slowdown. I won't take away from that, but I think when I look at it on a relative basis, I think we are still doing quite well. We have recovered. We are still like much above the pre-COVID levels. I think we would be like around at least 4% above pre-COVID levels. So to that extent, we are making progress. But yes, it's slowed down a little bit of what's happening in the global economy. But I think relatively, we are still quite good, I would say.
Right. So you mentioned one point about global capital flows. So
Yeah.
if I could ask you a related question there,
Yeah.
the US economy seems to be facing something which is akin to stagflation, and this
Yeah.
is for the first time since the 1970s. So what will be the impact on capital flows? That's one. And two, what impact will a weak global economy have on the startup ecosystem in India?
Sure. So I think historically, when you look back, the US economy has an effect on every other economy in the world. And I think even the US Fed bankers have been writing books in terms of you can't escape the fact that when they try correcting or defending their economy, their inflation, it has a ripple effect on the rest of the other economies. So as we see now, yes, they have high inflation. They want to control it. They want to bring it down to a level where there is a sustained growth. One of the ways they can do it is in terms of interest rates and also in terms of controlling liquidity. While they have made small movements in terms of increasing the interest rate, but it's just their communication out to the market. I think has led to a situation where everybody is chasing at least that risk-free rate that you get in US. And to that extent, there would be capital, you can look at it as capital flowing back to the US, or at least capital that was initially flowing into emerging countries is going to slow down. You can phrase it as you want it. But to the effect that will we seeing the same sort of capital flows that we were seeing earlier? Yes, we wouldn't see that. I think we should all budget and we should all think about that. Now, specifically a question on the startup ecosystem, there are, I think, a couple of ways it plays out. And way I slice and dice this is, when you see these sort of capital flows, I think the first immediate effect is, of course, on the public markets and not so much on the private markets. And again, and this is more a hypothesis from my side, because most of the funds which are investing in India have their commitment in place. I agree that now if you go do a fundraise, it's a little difficult. These macro do have an impact. But for funds which have raised or which have commitments in place, for them, I think it shouldn't make too much of a difference in terms of how the private market gets affected, in the sense that there is still, I think, dry powder for investors to invest. So that's one. But is there an impact of public markets, how some of these companies could have got listed, raised large amounts of capital, like let's say what Zomato did or Policy Bazaar did or Paytm did? That will be a little slow in coming. It won't be as fast. And you can see that effect in terms of a lot of them pulling back from their IPO plans. So that's one effect that we do see. But having said that, just in terms of them getting funded by private equity firms, I think that should continue. Now, is there a moderation in terms of investors taking a step back and being a little more considered, going through a little longer period of evaluation than the frenetic pace that we saw, at least, let's say, 12 to 18 months back? Definitely, yes. But I don't see that as a big worry. I see that as actually a correction that was due. Because I think that frenetic pace that we saw 12 to 18 months was a little unsustainable. Of course, there is a third effect. I think if some of these startups, having proved and addressed a time here, if some of them were trying to say that there is also a global market and some of our global markets are core markets for us in terms of growing our revenue, growing our profitability, at least some of those startups will, of course, have an effect. These mostly like the SaaS companies. But if you look at it, bulk of the ones at least seem to be relying on the domestic consumption, relying on a TAM which exists in India. So to that extent, I think that overall scenario that we spoke about, at least on the business side, should not be so much of an effect. I think that's broadly how I see it, and differently in terms of late stage companies for accessing public markets, for in between, before that, prior that, in terms of accessing private markets, I think it should continue. Of course, will it be at the same pace and same easy valuations as before? Probably not. because valuations have corrected across. And then there is, if you're relied on global clients or exports, I think there will be some amount of slowdown that someone has to budget for. I think that's how we see. Now, if I wear the investor hat, now I did explain all from, let's say, a company point of view, but if I have to wear the investor hat, I think it's a great time to invest for us. Because I think all these companies are strong. As long as the business model is strong, team is doing well, execution is good, I think valuations have at least become a little more reasonable. You get a little more time to evaluate, have discussions, discuss with the founders, the overall vision, strategy, come to a good conclusion and alignment, instead of just jumping in and noticing that you have a misalignment or whatever. So to that extent, this is, I think, a good vintage for investors actually to be putting out money and funding some of these companies which are doing quite well. And of course, there's going to be a quality differentiation here. I think if you earlier there was a thing that the tide is raising all the boats. Now there is a bit of differentiation. You have to. I think quality companies will get funding. There will be some companies which will struggle, but I think that's the natural course of any startup, any business, to capitalism as it plays out. Yeah.
Sure. No, that's indeed food for thought. And you mentioned about the correction in valuation. So
Yeah.
which are the sectors that have seen this correction in valuation? That's one. And in your firm, have you seen a situation where deals have had to be renegotiated because of valuation issues and stuff?
Okay. So which sectors? Okay. So when I spoke about the valuation correction, I was largely speaking of the startup ecosystem that we were speaking on, right? Of course, you know that our core four sectors are four, where we do healthcare, financial services, consumer, and technology-based services. So if you look at in those sectors, these are in the traditional side at least. There has been corrections, and I will come to like by sector, but it's not as big a correction as we saw in the digital first companies, because there it was more an art rather than a science, because there's also not a long history or a cash flow to look at. Now, specifically in the traditional sectors, I think what we have seen is, I think pharma has done quite well. I mean, it has not been if I pan it over over several quarters, I think it has gone up substantially and then come down. Would I now call it at saying that it has considerably come down to what it was, let's say 6, 7, or 8 quarters back? I think not, because I think there is still a lot of opportunities. Pharma is doing quite well. Healthcare has held up very, very well, in the sense that they did go through a dip during the COVID times, but and now if you look at it, all of them have come back. Both performances improved sharply, and their valuations also have corrected quite a bit. But I think what we see here is a separation, again, the same quality that I spoke about earlier. If they were all bunched around a certain narrow band, now you see it spread out. You could see the multiple of one company could be almost like 2.5x of the last company that is traded in that. So there is a separation that has happened. Financial services definitely has corrected. Technology, to a certain technology-based services, has corrected. Consumer companies have definitely corrected quite a bit. So to that extent, I guess it's quite a sectoral sort of a story. There have been some sectors which have benefited from the entire COVID supply chain disruption. India being a destination for manufacturing, hence has done well. I think healthcare has benefited for saying that people have realized that our healthcare system, everyone had concerns on cost, price, but they never focused on in terms of capacity being built. There was a pause in capacity building in healthcare. But I think during COVID time, people realized that we are just behind on supply compared to the demand that exists. And I think now that's playing out, even in terms of the prices not being so much of a concern as quality being sought for. And with all that pent up, performance has come back, valuation has come back. So sort of a mixed story. But startups have definitely, I think there was a pace at which everyone was chasing the deals that were happening. They had run up quite a bit. But just looking at an overall trading valuations of how the tech companies have corrected in the US, I think as one thinks about in terms of 3-4 years hence, what should we think of valuation and what can we afford to pay now? I think those have undergone some correction. So to that extent, I think people are seeing lower entry more because I think everybody is factoring a slightly lower or a muted exit valuation based on how all the tech stocks have performed in the US also. I don't know if that I answered all the questions you said. I know, Paramita, you asked me 2-3 things. I don't know if I've covered all of that.
No, no, absolutely. You've
Yes.
covered all of them. So just, one related question. So when we talk about the valuation, so, what I understand is it's the right time for investors to clock certain deals
Yeah.
because, obviously it's valuations have turned more realistic.
Yes.
However, having said that, do you think there's a catch-22 situation also? Because when valuations have come down, this would also mean that it's the most difficult time for investors to score exits, right? So how do you look at balancing both investment and exit objectives at this time?
No, sure. No, completely understand this. Okay, so one, yes, I said that valuations have corrected. Now the second thing, when I say valuations, also I'm looking at it like a multiple on a multiple basis, in the sense that you remember the time that we went through where one company would raise money in one quarter, the next quarter or 2 quarters later they're again raising at, let's say, 2x the valuations or 1.5x the valuation. I think that's the sort of pace that has dropped. Some of these companies are still doing quite well to the fact that their business performance is improving. Now, when I say valuations is corrected as a multiple, so let's say even if it's the same valuation or a 10% higher or a 5% higher, but on the size of that business as a multiple, I think it's a huge correction. That's what I meant by saying that it's corrected. Having said that, I won't duck away from the question that there might be some companies which also have to think about down rounds. It is tough. It is not that easy that it can happen. But I think the way I think about it is there will still be few quarters where they will get funded by the existing investors in terms of rights issues, everyone pitching in, trying to say that let's grow it for one more quarter, let's grow it for 2 more quarters, and then go back into the market. And I think everybody is trying to solve for what I said, in the sense that if you can show that growth in that 1 quarter, 2 quarters, then even if it's a slight up on the previous valuation, but at least as a comparison to the business values, even in terms of, and whichever one you pick, right, revenue, profitability, if they are profitable, or even in terms of some of the unit metrics, it would look much reasonable than what it was on that multiple basis. So to that extent, it would get solved by that. But companies which definitely need funding, which for growth or even for sustaining operations, I think they will still, yes, they will have to swallow something and take money at slightly lower valuations than before. But there will be very few cases. I think these are all companies which need funding because they're growing so fast. Because there's always a play on that, right? There, I think everywhere growth was more important than profitability. But when you realize that funding is difficult to get in terms of multiples you don't want to do, you just have to rejig some of that equation in terms of growth versus profitability. But having said that, I still think that investors have money, investors are keen to invest. Now, will deals happen at the same prices that you play one investor over the other investor and end up closing deal processes much, much quicker? I think that will not happen, in the sense that it'll be a little more, it's like any other time that deals have happened, right? It will go through a period of evaluation, it'll go through a period of alignment between investors and founders. Of course, investors have done a lot of work and they're ready to move fast. But still, there will be a lot of discussions in terms of alignment. How do you see strategy? How do you see overall vision playing out? So to that extent, deal processes might be a little slower. But when I say slower, it is not like slowed down. What I meant is that there was a frenetic pace earlier, which gets corrected and comes down to normal. I think that's broadly how I would view it.
Sure. Sure. So any comments on the exit market? Already, there's been a slowdown in the
Yeah.
exits in the industry.
Yeah, no, sure. I think way again you see it is again two things, right? IPO as an exit market has slowed down. There is no denying that, in the sense that if there were companies which, if there were investors who got exit by listing a company, now that has slowed down considerably. Having said that, in the last 1 month or 1.5 months, again, we are seeing companies coming back into the IPO market. But even with that green shoots, I wouldn't classify saying that we'll get back to the same level as what it was earlier. So IPO markets definitely had slowed down. If that's a mode of exit, I think it will take a little bit longer than what it was. Having said that, like when I say that it is a good time for private equity investors to invest or investors to put out money, so to that extent, if someone is trying to get an exit in terms of financial sponsors doing a secondary and buying stake, I think that is still possible, in the sense it will take longer. It won't be at the same pace as what was earlier, and you can't keep bidding one versus the other. But I think there is a sensible discussion to be had between investors to say that, because there will always be some venture funds which have done their time. There'll be always some slightly later stage larger funds who are looking at the next stage of growth, looking at growth slightly differently, looking at deal sizes slightly differently. Now, is there a conversation to be had between these two types of investors to see if there is a sensible construct that can be arrived at? It can happen. So to that extent, I think there is capital, there is appetite to the fact that exits through secondary market or the financial sponsor to financial sponsor, I would say will still be important and will continue to be strong. And like as we speak, even in some of our portfolio companies, we are having conversations, or at least we are running processes, and we see the interest there is extremely strong. And of course, it's a sector dependent story. But having said that, I wouldn't say that exit has dried up. There is one form of exit which has dried up, which is IPO. But if you broadly look, that it was a small part. It was a brief period. It became a large part, but otherwise it was a small part of overall exits that you see for investors. So that's my broad way of in terms of how I see exit. So if you have to overall weave a story between the exit and the investments that you're speaking, I think that both will continue. There are investments to be made, there are exits to be made, and I think depending on the vintage of the different funds that each firm is managing, depending on the need that arises, I think you'll continue to see exits and you'll continue to see investments. I mean, for example, we will continue to invest of our current fund and the next fund, and we will continue to exit some of the companies in our previous fund, all for managing vintages. And I think both there is enough interest and there is focus from, I think all the firms in India also have matured to that level that they're looking at. It's not like there is a period of just investments and there is a period of only exits. I think all of them are in that 3-4 fund management sort of a situation where they have to manage all three, which is investments, exit, and in between in terms of just the value creation in the companies and just working closely with the companies.
Sure. Sure, absolutely. So now talking about True North specifically, now, I mentioned a while back that it's been in the system for so long and it's seen so many cycles of investments and exits. So any take on how the PE landscape in India has changed, and how do you compare the market here with that of, say, the other ones in Asia?
Yeah. No, so I think the PE market has, if I look back and I'm comparing like a decade back and now, I think the way I see it is that the private equity market has matured quite a bit, in the sense that earlier, and when I say private equity market, I don't mean just the private equity firms, the entire market ecosystem, which comprises the bankers, the intermediaries or the consultants who work, the founders, and the firms themselves. I think there's a lot of maturity that we currently see. And what do I mean by that? I think just at the investment stage, I think the founders' clarity of private equity, what it means, what are the things that they are getting, what are the things that they have to work differently when they take investments from private equity firms. I think there is a lot of maturity. Earlier, it was almost like you were evangelizing, trying to sell the concept of private equity, what it means. I think there is a lot of maturity there that people are quite willing, and you see that more in control. We do a lot of control and buyout transactions. So to the extent that the control transaction discussions with the founders, I mean, distinctly remember how difficult it was 10 to 15 years back, and how easy it is now. And that's a big sign of maturity, that you can actually have this conversation and you see the number of deals that are currently happening. So that's one. Second, I think there is enough firms also who have come in. I mean, even if you look at the volume of deals, not only volume, but just the value of deals. If you look at it from 18, 19, 20, 21, 22, I think it's just at a quite a good level. I think everybody is seeing one, that India is a growing economy. There's a lot of opportunities. They're also seeing that some of the startups and the companies have matured quite a bit, and there are investable opportunities. So a lot of global firms are entering India, and that you see by the size of the private equity market itself. I mean, it's arguably the last year we would probably be one of the largest private equity market if you take the 2021 into play. So to that extent, that adds a lot of how should I say? Everybody is then rational. So I mean, we have been in a lot of deal situations. Let's say in traditional companies like the traditional pharma or the old companies, where you see that everybody has been there in the market, understand, they've tracked businesses for long. It's not that somebody is winning a deal, paying some 25%, 30% higher and winning away deals. I mean, deals are won and lost on various other things in terms of your knowledge of the sector, the comfort you give to the promoters, and valuations is such a small band. That's a sign of also maturity, that people are seeing the companies similarly. There could always be some delta in terms of the risk or sometimes the vision that some of the funds have. So that's maturing quite well. And that's also a sign for exits, right? If it's such a deep market, when you are exiting, you know that equally there are other firms which are looking at larger deal sizes. You would have gone in at a certain X, your companies are now worth 3X after all the value creation that's happened. You know that there are firms which are doing deals at that 3X level, and they're the ones who can actually give you that exit. So it's not relying only on IPO market, but these are the ones who take it from that 3X to the next level in terms of a 7X, 8X sort of a size. So to that extent, even the exit market has matured quite a bit. So that in turn plays on your entry also, right? So to that extent, that if founders are mature enough, companies are mature enough, you know that the exit is matured, gives you a little more leeway even in terms of looking at companies and trying to construct an investable opportunity or an investment thesis there. So to that extent, that has done extremely well. Of course, is there, with so many of them being there, is there a pressure on valuation and is there competition there? Definitely it is. And I think that is. But that's a part of any markets, any cycle. And it's also play on the growth and profitability growth that we are seeing also in the companies. Because it's not that we did say even like 5-10 years back that valuations here are quite high compared to, let's say, Europe or US. But on the same high valuations, a lot of private equity firms have delivered return. So to that extent that you know that there is a business growth which is sustaining some of those valuations. So I guess there will always be cycle and noises around this. But I think that's another sign of maturity of how the private equity market is the same. So overall, if you look at it, and also in terms of sectors, right? Earlier it was in terms of few sectors used to have investable opportunities, but you'll also see now that it's quite deepened in terms of the number of subsectors you can drop if you have a certain deal size in mind. That's been fairly large. So to that extent, actually each firm can have their own thesis and specialize in a few sectors. And conversely, so the market gets nicely segmented that way. That if I like a certain theme in some sector, so I might be in healthcare, some other fund is in healthcare, but have a slightly different subsector theme, or that I'm chasing, somebody else has a different one. So to that extent, there is also nice segmentation that is happening. So these are the signs that I see. I think the value of investments that is going in, how the exits are panning out, how the entire ecosystem is getting mature. And the third is even in terms of the type of deals, that there are control deals, there are buyout deals. I think that all of this, if you put together, I think, and this will continue, right? All the people who are investing now, they're going to see their exits. So this is a cycle on which there is going to be a good growth on the entire private equity market here in India. And that's playing out. You see several pension funds, you see several sovereign funds actually at least making announcements of saying that India is a core market. I need to be here. I need to have a team also which is here. I need to have some GPs here. So that's the final, I guess, the report card in terms of how the global investors also are seeing India.
Sure. You mentioned two very critical points here about maturity of the industry, and two is about how global funds are looking at entering India or have entered India. Now, I
Yeah.
wanted to understand from you, how would you differentiate, say, between homegrown versus global funds, and what are the key advantages that
Yeah.
homegrown funds have, and how are you planning to leverage on them?
No, sure. Um, No, I won't make this a competitive marketing sort of a spiel on homegrown versus global.
Hmm.
See, I think that's the other sign of maturity, right? I must add here that I think there was, I mean, 10 years back, if were having this conference and if you had asked me this question, I would have given you some 2 or 3 points, which are the standard global versus Indian sort of points. But if I have to actually step back, um, I think nobody has thought on those binaries that there is a global fund, there is an Indian fund. And what I mean by that is each one when they go and sell in the marketplace. See, one, there is definitely a place, there are two places we compete, right? One is in terms of globally, in terms of fundraising. We are in the market, there is a global fund in the market. Now, do they have an advantage in terms of re-ups for them is a little more easier than, let's say, a homegrown fund which is going? Definitely yes, undeniably yes. It might be easier for them to raise capital with an India allocation than for us to raise an India focused fund, especially in the current macro sort of situation that we are doing. So that is one way where we compete. The second is in the deal space itself with the founders and with the intermediaries. Now, there I've noticed that there is no binary of this global versus homegrown, because each one of us have at least positioned ourselves or differentiated ourselves on a few things that work for each one of us, right? And why I say that there are no binaries is I've seen that there are some of those points might be common between a global and an Indian player. And equally, two Indian players might be fighting on very completely different differentiator. So if I have to speak on just us, and you will notice that there is probably like of the 4 or 5 points that we go and stress, maybe there'll be like one point which is like a differentiator over a global, but otherwise we just see firms as firms competing in a marketplace, having their own differentiation. So for us, like you mentioned, the fact that we have been here for almost like 22 years, 23 years is a big positive. And that means that we understand the space well, we understand the sector well, we have developed deep relationship. Second, that because we have been focused on a few sectors, we understand those sectors extremely well. Most one, because of the work that we have done thus far. Second, more importantly, it gets multiplied in our case because we have done a lot of control transaction, and control transaction you tend to be a little more involved than, let's say, passive minority situations. So to that extent, just our engagement with the companies has given us a little deeper understanding of some of those sectors, because we've been there. We understand it ground up rather than just understanding at summarized figures level. So to that extent, that is a great advantage for us. Third, along with that relationship, because we have done control, because we have been recruiting, trying to recruit CEOs, CXOs for our different companies, we understand the talent and the management space quite well, in the sense that we have a specialized person in our firm who helps our companies in terms of recruitment. So to that extent, we have like a database of candidates that we have had earlier conversations with. So that is something that we rely on quite a bit. And even if when I go and have conversations with our founders, I do stress upon this fact quite a bit, that we can, if they need help, we'll be able to help a lot on that front because of our past relationship, and we know the talent in each one of these subsectors that we are thinking. And the other most important one is our relationship with founders, right? We just, based on being here for long, we have a certain playbook in terms of how we engage with each one of our companies. And this is again, like you can take minority, majority, across all the things, you will find that, and we are very confident of this. I mean, one of the biggest points that I tell all the founders that when I'm competing with some other firm is, please pick up the phone and call any one of our founders that we have worked with. I won't give you a curated list, but you pick up, you go check website, you pick up, you call anyone. I'll give you the contacts, you speak to them, because we are confident of the work that we have done and the engagement that we've had. Because if someone does detailed reference checks calls, we know that we'll come out quite well in some of these in comparison with a lot of funds. So we see that as a great differentiator. I think these are, and just the experience, right? And here I'm not speaking of just one person. It's just that whole team having spent that time, and each one of us spending time with subsector relationship. I think it's that combined effect. Even when we go back and feed on each other, I think that those are a couple of things. So in all of this, right, there is one additional point that we make to your question on the global versus homegrown, and that's the only point. Like I mentioned, all the key points, but this is one more point that we make, where if the global funds are saying all the things that I said above, right, then the additional point that we make is only this, that for us, decision making is fast. We don't need to go to any global IC anywhere. For us, even when we have invested in a company, if there is let's say a company is doing an M&A, if they're trying to do an acquisition, even for us to give approval, have a discussion at the board meeting, I don't have to go check with multiple people through a global IC as a sector expert or a global expert and come back. We can pretty much come back to the companies quite quickly, and that makes it much easier for founders to interact with. And that's the only point that I stress, and that's like one of the fourth or the fifth point, right? Only to differentiate against global, but otherwise, like I said, we don't see it as binary. I think some of the points that I make can work against some global, can work against, might not work against all the global firms. So you will have to pick and choose in terms of what really is your strength and what works. So, sorry, long-winded answer for your simple question, but
No, I think that was very, very in depth, and that definitely, that's definitely a lot of food for thought. But from control transactions, do you also plan to shift towards early stage deals? Because a lot of Ps and VCs seem to be competing in the same investment space. I mean, even the likes of Tigers, the Tiger Global and stuff, they are
yeah.
also, foraying into that space. So any plans for True North as such to foray in that space?
Yeah. So just quick clarification. See, I think we've done a lot of controls more than any other firm. But having said that, I don't want to take away the fact that if you just broadly look at the deals that we have done, it's a 50-50 between minority and control. It just so happens that we have been in the market for so long that we have done the maximum number of control transactions. Having said that, it's not like we have not done minority. Even half the number of our deals is minority. Of course, because the control deals are larger, takes in more capital for growth. Maybe like 60% of our capital goes towards control or buyout situation, but minority is something that we have been doing for the last 22, 23 years, especially in my sector, right? We have done more minority than we have done majority because it's such a specialized field. So that's one clarification upfront. Now, on your question on the stage of a company in which we enter, we still enter at a later stage than an earlier stage. And I think on a relative basis compared to, let's say, the venture companies, it still will broadly hold true across our subsector. And now the only case where we had been contemplating, and even now we have not done, is you can argue looking out from the outside that if we had somewhere that we will invest only in companies which have let's say proven their business model, and we are only funding for growth. There is no discovery on the business model. If that was a thing that we held earlier, now have we also invested in companies where the business model will go through a bit of evolution? Yes, it will, because some of these digital first companies, because they're disrupting so much and attacking they're trying to address so many different kinds of problems and disrupting a subsector. So to that extent, some of their models will go through that evolution. Now, in that stage, you can call it that the stage at which we enter and invest in those companies, is it earlier than what we have done with traditional companies? Definitely, yes. But having said that, if you do a gradation relative to the other firms, it will be at a similar stage, in the sense that venture guys would have invested and then we are actually coming in the next round. It's unlikely that we will be investing in a startup where we are the first investor. I wouldn't, yeah, I mean, that would be probably a very rare case, unless that startup has, like, with only internal accruals and promoter funding, has grown to a size where it's like is one of the leaders in the industry, and then we might be the first investor. But otherwise, to that extent, you could argue that it's slightly earlier stage than what we have done before. I think those are the only two cases, and especially for the digital first companies, because some of these companies were coming quicker to, let's say, the larger funding rounds and weren't going through the usual evolution of, let's say, angel investing to venture investing to then growth investing to then later stage PE to public markets. If there was a traditional evolutionary path that traditional companies followed, the digital companies are skipping a few steps. They're going directly from venture into hedge funds or sovereign funds investing. So to that extent, should we look at companies slightly earlier than rather than just keep waiting for them to come? And I think that's the work that we did a lot. We looked at how these companies are scaling up. We have done a lot of prior work. Are we in a better position to take call on these companies and go in earlier than we would normally have done? Yes, we have, because that's because of the work that we have done. The last 2 years, headline, you would see that we have not invested in many digital first companies. But if you speak in the ecosystem, either to founders or to even some of the people who work closely with firms and help them evaluate some of these companies, you will see how active we have been. Because of all that work, we have like now a sharply defined list of companies where we like the sector. We have done work to develop comfort on the team, where we know how that company is progressing. We have tracked it over several quarters to see in terms of what progress that they're making. So we're in a far better position to take a quick call and enter these companies. While you might call it that it's still earlier stage than what we have traditionally done with the, let's say, the brick and mortar companies. But the amount of time that we have spent is enormous in tracking and making ourselves competent to close deals fast in this sector. So to that extent, you could call that. And I guess that's what people are referring to. Because the work that we have done on some of these companies, they would have probably thought that it is earlier stage than what we would probably enter. But we have always viewed it as saying that we should get to see it over time. And that's what we have done over the last 2 years for us to be able to take quick calls and enter some of these companies.
Sure, sure. So if I also may ask you about the status of your seventh fund.
Sure.
True North has been making headlines in the past with media reports stating that it's looking to raise over 600 million and stuff. So how challenging has it been on the road, in such a tight macro environment? And how do you think LPs are viewing the market now?
No, sure. No, so you're right. We are in the market. We are trying to raise a fund. And you're also right. News is always ahead of, and I think people are come out with all guesses in terms of what we are going and raising. We don't normally, for any of our funds, we have never put out a number in terms of what we are trying to raise at all. And I don't think even our conversation with our own LPs or investors, they are like giving any of these numbers out. So there's a lot of speculation that keeps going on. But to your specific question on how is the environment, is this like a desirable, easy environment to raise funds? I would say not. There is a lot of, and it's nothing hard facts on the ground, but it's just that things are changing so much that it's so uncertain that people are just getting comfortable with a risk-free or a slightly safer haven in US. You're getting similar returns. Then they're saying that how do currencies behave as central banks are taking some of these actions? So it's an overall broader asset allocation calls that LPs are still grappling with. Having said that, do we agree with all of those calls? No, all the factors are true, but I think there's a more important factor that people are missing out is the growth opportunity here. And I think we spoke on the economy, we spoke on some of the startups in terms of how they're growing. Now, do you find similar sort of high growth investable opportunities in every other economy or country? Most likely not. I mean, you'll find more here than there. So we can always agree to disagree, but I guess overall investors also have their overall in terms of globally, how are they looking at the different markets? What are they prioritizing? How are they looking at currencies? How are they looking at the returns? So to that extent, all of these are uncertain in the sense that if they've done that work, it was a stable environment. It's still a very answerable question. But in an uncertain environment where everyone's guessing in terms of what's the next month going to be, and even today, I'm sure People are waiting and seeing what is the good Fed going to announce at the end of the day. So in that sort of an uncertain thing, is this the easiest time to raise a fund? It is not. But we are having, I think what works well for us is we have been in the market for long. Our team has been stable and together for a long time. And we have been working with some of these investors over like 6 funds. So to that extent, it's not like they're taking a call on a new fund or a new GP. So to that extent, that's the balancing factor. So we are having conversations, and I think while trying to answer in terms of why it is difficult, I've given you a sense in terms of what LPs are thinking about in terms of how they should think. And I think that's the balance. And I think as some of these things settle down, I think it should get easier. So the only pity part in this is, like, while I said that the fundraising, and this is like the dichotomy here, right? This is a difficult time to raise money, but this is also the best time to invest. So to that extent, it's not like we have investable runway in our fund 6 itself. Now, why are we still on the road? It is because we think that the market investing opportunities in the market are so perfect or so nice now that we think that we can put out more, we can do larger deals, we can do many more deals. So to that extent, if there is a certain reception, we could go and raise that money. But otherwise, I think we still have runway in our current fund to continue investing. So to that extent, that doesn't solve. But we were trying to solve for it was almost like a opportunity lost if you don't have. We could do far higher deals than what we are currently doing. So we can continue at the same pace, but we think that we could increase the pace substantially if the macro wasn't the way it is, and we could actually raise that fund. So let me just pause at that.
Sure. So I think we are running short of time.
Sure.
So, in terms of your concluding statements for the PE industry, the startup ecosystem, the funding, the exits, what would that be?
Sorry, Paramita, just for a brief while, I lost you.
No worries. So I'll repeat that for you. So
Sure.
I was asking you, what would your concluding statements be in terms of investments, in terms of exits, in terms of fundraising,
Yeah.
anything? The
No,
concluding
sure.
statements for PE industry.
No, sure. No, I think one, I should say that I'm very optimistic on the Indian private equity industry itself, and more so. And we've always been there. It's our job to be optimistic. But if you just look at the hard facts over the last 2 to 3 years, I think it's incredible in terms of the way the industry has grown, the way the industry has matured. And I'm not saying suddenly that there is a blip some year, but just the way it has matured in terms of how deals happen. I think we are in a great place. I think it's reached that 50 plus billion last year. Still, even when you take the first half of this year, there's almost like 27 billion that has been put out. So to that extent, the size is there. The maturity is there. I spoke about founders, I spoke about the ecosystem, and I spoke about many funds entering, and a lot of pension and sovereign funds also, in terms of saying that this is a market that we have to keep track of, and this will come up for their decisions later on. So that's extremely encouraging sign. And even with all of them there, and I think they've all behaved responsibly, even in terms of when you look at how deals get done, while it is competitive, but also there's a lot of rationality in when you see the deals, even both in terms of how people compete with each other, and also in terms of how secondaries are happening from one, let's say, when I say secondaries, in terms of one fund exiting, another fund buying over stake from there. We have seen several such cases where it's been done in a very considered and in a very proper manner. It's not like one trying to get up over someone else. So to that extent, that has matured quite a bit, in the sense that people don't think a lot in terms of saying I'm buying from a private equity fund, what other leeways or headroom for growth is there. So that's not like, it could have been a conversation like, let's say, 2 decades back, but it's like a far easier conversation now. And with all of this, even the founders, management, talent, how they work with private equities has matured quite a bit. And when you look at it from the macro perspective, India is doing I can't say on absolute basis, but on a relative basis, doing quite well, in the sense that we have growth in their economy. There are several sectors which are like showing strong signs of how they are growing. It's not just the numbers that they're growing. Second, our currency, while it's under pressure, when you look at it relatively compared to other currencies, we can't take away the fact that we are also a trade deficit company, right? Country, right? So for that extent, that if oil prices go up, our imports go up, our currencies are under pressure. But even then, if you look at how our exports also have gone up considerably, and the forex reserves that we have, our currency has done reasonably well. So to that extent, I think it's a great destination for actually people to come. I know I'm attracting competition by saying this, but I think competition is good in terms of how the industry matures and how everyone invests and work here. So,
Oh, yes,
very
certainly.
optimistic.
Yes. Now, I believe competition is always good. I completely echo the same thoughts as yours. Yes.
Yeah.
So on that note, thank you so much, Satish, for taking time out once again. And it was a very, very enriching and in-depth discussion.
No, pleasure, Parmita. Always a pleasure interacting with you, and thanks a lot for the session.
Thank you.
Yeah,
Thank you.
thank you.